When you think about the US economy, you assume whatever's going on in Japan doesn't matter. But that assumption is dangerously wrong. Because for the last 30 years, Japan's near zero interest rates have quietly financed trillions of dollars of global investing. Hedge funds, banks, and investors around the world have been borrowing cheap Japanese money and pouring it into assets like US stocks, US bonds, real estate, and even crypto. But now, Japan is starting to raise interest rates, and that flow of cheap money that's been supporting global markets for decades is beginning to disappear. So that raises a very important question. What happens to the US economy when one of the biggest sources of global liquidity suddenly gets cut off? So, to understand how Japan could impact the US economy, we first need to understand something called the yen carry trade. The basic idea is simple. Investors borrow money in a country where interest rates are extremely low, and then they invest that money somewhere else where returns are a lot higher. Japan became the perfect place to do this because for almost 30 years, interest rates in Japan were basically zero. So investors around the world started using Japan as a cheap source of funding. The way it works is they borrow Japanese yen at near zero interest rates, convert those yen into dollars, invest that money in higher yielding assets like US stocks, treasury bonds, real estate, crypto, and then they pocket the difference between what you earn on those investments and what you pay to borrow. For example, imagine you borrow money in Japan at a 0% interest rate, and then you invest that money in US bonds earning around 4% per year. Your profit is that 4% difference, and your risk is almost nothing. Investors will do that trade, and they'll also amplify it using leverage because the risk is so little. So instead of borrowing 2 times their money, they're borrowing 5 times, even 10 times their money, which means very small profits can turn into very large returns. This type of trade worked incredibly well for decades because Japan kept interest rates near zero from the mid-1990s all the way until 2024. The reason the Bank of Japan has kept interest rates so low is because they were trying to fight deflation. That's when prices fall every year, not rise. So to incentivize people and businesses to borrow money and spend more in the economy, they kept borrowing costs extremely low. At times, they even pushed interest rates below zero and introduced policies to cap government bond yields. So for almost 30 years, Japan had the cheapest money in the world. But now that entire system is starting to change. In March 2024, the Bank of Japan raised interest rates for the first time in 17 years. This moved rates from negative territory back above zero. And they also ended a policy called yield curve control, where they had been capping government bond yields for years. This was a major shift in policy. The reason for the change is because Japan is finally experiencing sustained inflation, with prices rising above 2% for more than 3 years. At the same time, wages have started rising at the fastest pace in decades. So they started raising interest rates. First in March, then again in July, bringing rates to 0.25%, and by December of 2024, rates had reached about 0.75%, the highest level Japan has seen in decades. And most importantly, the Bank of Japan has signaled that they're not finished. Their long-term target is something closer to a neutral rate of around 1 to 1.5%. That means more hikes are likely coming over the next few years. And this creates a major problem for what we talked about earlier, the carry trade, because the entire strategy depended on borrowing extremely cheap money in Japan when rates were near zero. Because when rates were near zero, an investor could borrow in Japan at 0% and invest in assets earning 4 or 5%. That large interest rate gap made the trade very profitable. But as Japanese rates rise and US rates eventually fall, that gap starts to shrink. Suddenly, you're borrowing at 0.75% and investing at 4%. Eventually, it could be 1.5% borrowing costs versus 3.5% investment returns. And once you add currency risk, especially if the yen starts strengthening, the trade quickly becomes far less attractive. And that means all of that cheap money flowing into US markets is now going to stop, and you even start to see investors pulling out from now. We actually saw a glimpse of what happens when the carry trade starts to unwind. On August 5th, 2024, just a few days after Japan raised rates from about 0% to 0.25%, Japan's stock market, specifically the Nikkei 225, crashed 12.4% in a single day, the worst drop since 1987, and the shock spread globally. The S&P 500 fell about 6% in 3 days, and the VIX spiked to 65, levels normally only seen during major crises. At the same time, the yen, Japan's currency, surged nearly 12% in just a few weeks. That's a massive move for a major currency, and this is where the problems begin. Carry trades are heavily leveraged, so when the yen strengthened, a lot of investors suddenly faced margin calls. To cover those losses, they had to sell assets like stocks, bonds, crypto, basically anything liquid. And that creates a feedback loop. The yen strengthens, carry trades lose money, investors sell assets, markets fall. That means more margin calls and more selling. And the Bank of Japan is still raising interest rates, so you can expect this to go on for a while. And there's a second way Japan could trigger problems for the US economy. Japan owns over $1 trillion of US Treasury bonds, making it the largest foreign holder of American debt. For comparison, China holds about $760 billion, and the United Kingdom holds about $880 billion. So Japan is a massive lender to the United States. But why does Japan own so many US bonds in the first place? Well, when Japan's interest rates were near zero, US Treasury bonds often paid 4 to 5%, while Japanese government bonds paid close to zero. So Japanese banks, pension funds, and insurance companies, they invested huge amounts of money into US debt. But that's starting to change because Japanese bond yields are rising. The 10-year Japanese government bond now yields over 2%, the highest levels ever since the 1990s. That narrows the gap between Japanese and US bond yields. And once that gap shrinks enough, Japanese investors start asking themselves a simple question. Why take currency risk in US bonds when you can earn similar returns at home? And that creates 3 scenarios where Japan might start selling US treasuries. First is currency intervention. If the yen weakens too much, Japan's government steps in to support it. To do that, they start selling dollars and buying yen. And selling dollars often means selling US treasuries. Second is by Japanese capital returning home. As Japanese bond yields rise, Japanese banks and pensions move money out of foreign assets and back into domestic bonds. We already saw an example of this in 2024 when Norinshuken Bank sold roughly $63 billion in foreign bonds. And the third scenario is political leverage. In 2025, Japan's finance minister suggested that Japan's treasury holdings could be a card on the table during trade negotiations with the United States. That kind of statement is extremely rare, and it highlights just how important those debt holdings are. So, what happens if Japan begins selling treasuries in size? Well, treasury prices would fall, and when treasury prices fall, yields rise. And those yields matter because US treasury bonds are considered the risk-free benchmark for the entire financial system. Every other type of borrowing in the economy is priced relative to treasury yields. So when treasury yields rise, everything else gets more expensive too. And you start to see your mortgage rate going up, corporate borrowing costs going up. Basically, credit becomes more expensive across the entire economy. And the US government itself has to pay much higher interest on its debt, which puts even more pressure on an already fragile financial system.